Hey guys, welcome back to my channel. I wanted to start a new series with you guys as I go through the ICT 2022 mentorship again and do recaps of 3 videos at a time to not only use as reference for you all but also for myself. So I just got done with all the core content and have a much deeper understanding of different models and concepts that ICT teaches. But in hindsight, this is really the only model you need for consistent profitability in the markets. So in the intro, he starts out with saying how he trades demo and not to rush the process. I personally recommend you listen to him and not fall victim to thinking you're different. So he mentions the concept of yearning, learning, and earning. This is important as we all yearn to be successful in this game, but we must most importantly put the time into learning and backtesting and reading the tape for up to a year before all these pieces start to come together. Lastly, he does mention the importance of taking personal responsibility for all actions. Making excuses of why the market does this or that is not going to help you grow. It will only slow down the process for you. So, from my experience, it is best to claim both the wins and losses and study, why you choose to click buy and sell and what you can do to improve for the next time. I'd recommend, a journal to write out what you were thinking before, during, and after executing the trade. Then reflect on both wins and losses and move on with your day. In episode 2, we start getting into the nitty-gritty with elements to a trade setup. He starts off with the importance of running the tape, which is, watching live price action and predicting where you think the price will draw to next. Also, how we want to be independent of all systems, indicators, and signals. I have personally been there and thought, following someone else's signal was the answer, but the losses always outweighed the wins, and I had no growth from leaving my trading to another person. We went into a weekly chart, which we pull up on the weekend before the next weekly candle opens, and we predict where we think the weekly will draw to, but don't try and predict the close. We don't need to. He mentions, seasonal tendencies, rate increases by the Fed, and earnings seasons led to his prediction of a bearish week at the time of the video. Basically, it comes down to, if you think the price is going to draw higher or lower. He then goes down to a daily time frame where a majority of, our analysis is done, and this is where most institutional and bank traders analyze their charts. We look for draws to buy or sell stops or an imbalance on the daily time frame. He drops down to a 1-hour chart and draws out the Monday midnight open. Again, that's New York midnight open, so Eastern time, UTC 5 for trading view, all the way to Friday close at 1600 for the weekly review. This is a great practice for backtesting previous weeks. By the way, he mentions anytime a significant price move lower is always expected. Always anticipate some measure of a stop hunt, as in buy stops or short-term high being taken out in the verse when we are looking for higher prices. He then drops down to a 15-minute time frame and draws out equal highs and lows with trend lines. This is area retail looks at as support and resistance, but smart money looks for as stop runs. Again, we expect stops to be ran before a significant move higher or lower. Now after the stops are rated, we drop down to a lower time frame chart, 3 minutes and below, so the 3-minute, 2-minute, and 1-minute, and hunt the break-in structure with a fair value gap to enter on. Once we entered, or before entry, we draw out the range with a fib from high to low of the day, of that move that's happening, and hunt for opposing liquidity targets on the discount side if we are shorting and the premium side if we are longing. Imbalances and highs and lows are typically our targets. Always aim for the lowest hanging fruit. This is a big lesson I have learned personally, considering we all have that greed inside and want the whole move up or down, right? We want that home run, when instead if we exit at the easiest targets possible and compound those wins, we'd be in a much better spot with our equity and our mindset, not deal with the pain of getting round tripped. Been there, done that. And finally, a good and easy thing to remember as if we are bearish on the day, we want to see buy stops ran. If we are bullish on the day, we want to see sell stops ran. And lastly, in episode 3, we embark on market structure shifts and internal range liquidity. Again, we start off by marking off equal highs and lows in areas of interest on a higher time frame. Liquidity lines are drawn with the 15-minute. Mention of market shifts only matter if a run-on stops occurs, and very important, we don't need a close above for market structure shift. We just need to be traded above or below. When this run happens, anticipate the market structure shift on the 3, 2, and 1 minute chart. When the shift takes place, we hunt for the gap and have room for a 3-tick entry on our limit order for indices. We want to see the fair value gap entry line up with the order block opening price. And definition of an order block is simply a change in state of delivery from buying to selling and vice versa, selling to buying. Multiple consecutive candles on lower time frame are considered one order block. So if we have 3 down closed candles, that's considered one order block, right? If it's on a 1 minute or 2 minute. And same for up candles if you're looking for a bearish order block. As we're learning, we want to make sure we draw out liquidity zones, buy and sell side, and the stop rates that are happening. We want to draw out highs and lows from Asian session, which is 7 to midnight New York Eastern Time, the London session 2 to 5 a.m., and previous New York open to 8:30. So 7 to 10 is the New York morning session. We typically don't trade New York lunch hour 12 to 1 p.m. and usually don't see much price action till 1:30, and 2 to 3 we start to see the afternoon trend unfold and can hunt setups then. But typically the session that we're looking to trade is 8:30 a.m. to 12 afternoon. For our back testing, we want to count the amount of pips, points, how long the trade took to pan out, how much drawdown we've incurred. And during his live trade example in this video, he mentions if we have two fair value gaps, we want to wait and see if the lower or higher one is traded to first and risk not getting the entry for a better buy or sell. So once we entered, we want to see accumulation and movement towards our target with bodies not violating the fair value gap. Again, he aimed for the lowest part of the imbalance, which was the lowest hanging fruit. That pretty much concludes episode 1, 2, and 3. If you guys do have questions, please comment or, at me on Twitter. I'd love to help anyone out, or if you guys have any feedback, I'd love that as well. First 3 videos are pretty much the whole model in a condensed form, and then he goes into greater detail, but very important. Screenshot that if you want to, and yeah, see you guys next time. Have a great night.